Hello everyone, this is Kevin Zhao, your finance professor at MTSU. I welcome everybody back to this online class. I know you have busy working schedule. Most of you work a full-time job, and some of you may have family to take care of. But in this class, I want you to know that you have a lot of work to do. Ideally, I want you to set up at least 10 to 12 hours each every week, reviewing chapters, practicing problems, looking at illustrations, and of course, watch this video. This is the second week of our study. During this week, we have 4 chapters to cover. Actually, four chapters to cover. Chapter 8, risk parameter. Chapter 11, estimating growth rate, and chapter 9 and chapter 10, which is associated with the cash flow estimation in your equity evaluation. So we have a lot of work to do, and this week could be a very stressful week for all of you. And I would say once you go through this week, everything else will become pretty much easier in the later weeks. So let's work hard during this week. You have 4 chapters to cover, a lot of problems to solve, and I want you to start working on your first exam. We only have 3 exams in this class, and each exam is take-home exam. Each exam will have 10 problems for you to solve, and I want you to use Excel spreadsheet to solve those problems. And all those problems are from the textbook, the end chapter problems and questions. During the class, I will demonstrate the process solving some odd number questions, and those even number questions may appear in your exam. So I want you to look at exam questions and begin to solve those problems step by step. You don't want to push all the exam questions toward the end. Just before the deadline, you won't have sufficient time to solve the problems. So I highly recommend you to go through at least like 2 or 3 or 4 questions each every week once we go through those relevant chapters. Any questions, please email me and let me know. I'm here to helping you. Okay, now let's start our chapter 8, and in this video I will go through half of this chapter, which is associated with beta. What is beta? Beta is a measure of riskiness for a stock. As we know, this riskiness is a key determinant of stock return. So when we needed to estimate a very important parameter, required rate of return, we needed to estimate beta of a company, because CAPM model, capital asset pricing model, shows that return of a stock or required rate of return of a stock equals risk-free rate plus beta times equity market premium. In the previous chapter, during the last week, we covered risk-free rate and equity risk premium. Now it's time for us to explore a little bit on how to estimate this beta. So beta is risk measurement of stock, and actually this beta measures systematic risk of a stock. Before we go through 3 major methods, I want you to review the content of beta in your previous course and textbooks. And actually, when you look at the riskiness of a stock, you see, typically investors may use standard deviation to measure the total risk of a beta. But in the context of stock portfolio, when investor builds a well-diversified portfolio, then unsystematic risk or firm-specific risk can be cancelled off, which means a proportion of the total risk can be diversified away, but still your portfolio and individual stocks in your portfolio are subject to so-called systematic risk or market risk. And this market risk can be measured by beta. How to estimate beta? In this chapter, I will show you that, okay, in your toolbox, you will have 3 tools to estimating beta. The first one is commonly used, market approach, where we use a regression to get an estimate of beta. That is a very popular way, and I will show you a little bit later how we can do the regression and estimate beta for a typical stock. And the second one is a bottom-up approach. Bottom-up approach is a fundamental approach where we examine the key sources of risk in a stock. Then we explore those determinants of beta and to get a pretty good estimation of so-called bottom-up beta. This bottom-up beta is based on the business fundamental of a company that is associated with its risk. And the last one is accounting approach, where we use accounting data to estimating beta. First of all, let's take a look at a regression beta. How to get a regression beta? Well, we run regression between two time series. One is individual stock return, the other one is market return, and typically we use standard S&P 500 stock index return as a proxy of market return, and then we look at individual stock return. So typically you first of all collect the data from the market. You may collect weekly data or daily data, and you will have 2 series. One series is individual stock return, the other one is S&P 500 return. And I want you to be cautious when you're collecting data, because when you're collecting data, you're getting the index. Let's say S&P 500, you're getting the index numbers, but the index numbers doesn't automatically show you the return. So you need to do a little calculation to see what is day-to-day change. That day-to-day change is the index return and individual stock return. So once you get a return, 2 time series of stock return and S&P 500 return, then you can run the regression. The easy way for you to run regression is to use Excel spreadsheet. That's a built-in function called regression, and then you do regression in your Excel spreadsheet. One variable is market return, which is RM in this equation. The other one is individual return, which is RJ. So the regressor is RJ, and the dependent variable is RM. When you run regression, you will have 2 estimates, A and B. A is the intercept of the regression, and B is the coefficient of the estimates on this B. B is the coefficient, and this B is actually the measurement of beta, which is a slope of the regression. And this is one of the most popular ways that investors getting estimation of beta. However, this beta does have 3 main problems. First of all is that this beta, the estimation of this beta may not be statistically significant. Let's say you had a beta of 1.2, right? But if this beta estimation has high standard error, then it may show you that this beta, although it shows the estimate is 1.2, but actually this number could be a negative number or even higher number, and this number is not reliable at all. That is a problem, which means this beta estimation may not be statistically significant. And the second one is about the timing of this beta. What we needed to use in your estimation of required rate of return is the current beta and the future version of this beta. But the beta that you're getting from the regression only reflects what happened in the past. First of all, this beta reflects the company's business mix during the period of regression, which is in the past, not the current mix or the future mix. But what we need is the future beta, which reflects the current business mix and the future business mix. And the second one is this beta reflects the past financial leverage, not the current leverage or the future leverage. So keep in mind, this regression method is based on historical data, which only reflects what happened in the past. Right? So if you believe that what happened in the past will be repeated in the future, then this beta could be a reasonable estimation. But if not, then we need to seek other way to get a better estimation of beta. Now let's take a look at this market regression formula. Rj equals A plus B times Rn. Once again, this A is the intercept from your regression. It provides a very simple measure of performance of the stock during the regression period. So typically you compare this A with R times 1 minus B. B is the beta, R is stock return. And the difference of those two terms is called the Jensen's alpha. If this number greater than 0, then it means this stock performed better than expected. What's expected? Expected return is return based on the risk of this company. If this number greater than 0, that means this stock did a better job than what's expected. If this number less than 0, then it means this company or this stock did worse than what's expected. Once again, this expected return is based on the beta of the company, and the difference of the return is called the Jensen's alpha. Very important measure for relative performance of a stock. And in the regression, you will get other statistical parameters such as R squares. And R squared is a very important measurement on how well this regression captures the causal relationship between stock return and the beta. And typically R squared of a single stock beta regression or market regression is a low two-digit number, 15%, 17%, or even 12, 13%. And I think once you get R squared around 13, 14, high teen numbers or even low, greater than 20%, that would be considered as a pretty good regression. But even for this pretty good regression, you cannot say that stock return can be determined by this beta completely, because R squared of, let's say, 15% tells us that only 15% of variations in stock return can be explained by beta. And we have 85% of variation that is unexplained. So that is one of the limitations of this beta. Beta can only capture a small portion of variation in stock return. So please keep this in mind. If R squared is pretty low, let's say 2-3% or low single digit number, then you would cast doubt on how well this regression captured this beta. And the second, you look at the standard errors of beta estimates. And this standard error actually measures statistical significance of the beta estimates. And from standard error, you typically will get other statistical parameters such as t-value. And typically, if t-value is greater than 2, that's a good estimation, which means confidence level could be greater than 95%, and you can say that, okay, with 95% confidence level, this beta estimation is not statistically different from 0. And in the textbook, I want you to look at illustration of 8.1 for the entire process of market regression by using data of the company called Bowen. Now, Let's take a look at a typical regression. A typical regression that is done by Bloomberg. What is Bloomberg? Well, Bloomberg is a financial information provider. Here is Bloomberg stock beta estimation ticket that we can get from Bloomberg system. By the way, MTSU does have subscription of Bloomberg. However, we only have very limited access to Bloomberg. There's only one machine available in Financial Analysis Center. But anyway, let's take a look at this Bloomberg beta estimation ticket. And the company is Amazon. Now everybody knows Amazon. It's an online retail company. And here we wanted to estimate beta back to, let's say, year 2000. And so first of all, we collect data, and here the analyst in Bloomberg picked a 2-year time period from February 1998 to February year 2000, 2-year time period. Regarding the frequency of the data, the financial analyst choose the weekly data. So within 2 years, there are a total of 103 weekly data. Within 1 year, there's 52 weeks. So total number of observation here is 103 and 3. And the 2 time series, one is market return, and here we choose S&P 500 index as the proxy of market return. And the other one is, of course, Amazon stock weekly return. When you get those 2 time series, then you run regression. And on the right part of this ticket, you see the regression line, and those dotted, those dots that you see on the chart is individual observation, and the line that you see in this chart is the regression line. And the formula of the regression line shows that, okay, y, which is the stock return, equals 2.23 times x. X is standard, not standard, S&P 500. S&P 500 stock market index plus 2.6. So what does this number mean? Well, 2.6 is the intercept of the regression, and a 2.23 is the beta estimation. 2.23 is beta estimation. Right? So if you use market regression method, then what you can get from this regression is beta equal 2.23. Right? So that's market regression. However, you see on the left side of the ticket, you see ADJ beta and the raw beta. And the raw beta, of course, is the beta that you get from this regression, but ADJ beta is 1.82. So what is ADJ beta? This ADJ means adjusted beta. The ADJ beta, I mean, when you look at the lower part of the left of this ticket, you see adjusted beta equals 0.67 times the raw beta plus 0.33 times 1. What does that mean? Well, this is a very typical adjustment procedure done by a professional financial analyst to get a so-called service beta. So here's the second approach to get a beta. Service beta. What are service? Service means financial information service provided by those active research companies such as S&P, Standard & Poor's, Morningstar, Capital IQ, so on and so forth. And also, service beta can be provided by investment bankers who does financial analysis for individual companies. And when they do beta estimation, of course they use this regression beta, but they incorporate some new information in this adjusted beta because they believe that adjusted beta may better capture the future beta. And the adjusted beta, I mean, from the equation of the adjusted beta, you see that beta has a tendency to go towards 1. If current beta is too high, and here Amazon beta 2.23, which is pretty high. On average, the beta is about 1, right? That is the market beta. Market beta should equal 1. If it's greater than 1, it means the stock is riskier than market. And the 2.23 means the individual stock is way more risky than the market average. Back to the 2000 for this Amazon. It's pretty reasonable. However, in the longer term, researchers found that the beta tend to be a time varying variable. It has tendency to go towards 1 if it's higher than 1 or significantly higher than 1, then it will go lower towards 1. If it's lower than 1, then it has tendency to go higher in the future towards 1. So this adjusted beta equation shows the tendency that in the future beta has tendency to go towards 1. So that is a very typical adjustment procedure done by financial analysts in providing those so-called service beta. Essentially, this service beta is other people's opinion. When you open, let's say, Yahoo Finance, Google Finance, you look at summary of a stock, and from that summary, you will see beta estimation. However, if you look at different sources, you will find that the beta are different. Why is that? I mean, when you do market regression, you're supposed to get the same beta, but from different providers, you may have different beta and different service beta as well. So what is the problem? Well, the problem here is financial analysts may have different choices when they do this market regression. First of all, they have several different choices regarding this regression time period. Are you going to use the past 3 months data, or 1 year data, or 2 year data, or even 20 year data? That's your choice, right? Of course, the regression estimate would be different if you choose different regression time period. And the second, you also need to make a decision on data interval. Are you gonna take the daily data, or weekly data, or monthly data? And the third choice is benchmark index. A lot of people use S&P 500, but other people may use other indexes. So, given analysts have so many choices, then it's not surprised to see that betas could be different from different sources. So, what's the best practice when you needed to run your market regression to get a beta estimation? Well, first of all, I think you needed to recognize the importance of matching principle. Matching principle. And if your job is to estimate near-term stock target price, let's say stock price in 3 months, then the best practice is to use 3 months data during the past to get this beta estimation. If your job is to estimate 12 months target price, which means stock price in the next year, then I think the best practice to use 1 year data or 250 trading day data. It's not 365 because during a typical calendar year, there's about 250 trading days. So if you use daily data for 1 year time period, in order to estimate 1 year target price, then you will have 250 data points of 250 observation. Right? And some people do long-term beta estimation, let's say 5-year beta. Then you may use weekly data or even monthly data. But I think a weekly data will be better because 5 year times 52 weeks, then you have more than 200 observations for regression. But if you use monthly data, there's only 60 observations during the 5-year time period. And the last one is benchmark choice, S&P 500, and I think most people will use S&P 500. So far we have two major tools in your toolbox. The first one is regression beta, and the second one is service beta. Now let's take a look at the third method, fundamental beta. And the fundamental beta is also called bottom-up beta. So here we look at the business fundamental of the company, and we explore three major sources of risk in a company. So what are three sources of risk? The first one is the type of the business. Certain type of business could be more risky than the others, and here typically you look at two different types of businesses: defensive business versus pro-cyclical businesses. And pro-cyclical business are of course riskier than defensive business given its business nature during a business cycle. And the second determinant of riskiness in a company is its operating leverage. Operating leverage. What is operating leverage? Operating leverage simply measure the proportion of fixed costs versus variable costs. In a company that has higher percentage of fixed costs, the company tend to be riskier. If company have a major proportion of costs are variable costs, then the company tend to have high operating leverage and a lower beta. So if company, once again, if a company has high proportion of costs that's associated with the fixed costs, then operation leverage is low and the beta should be high. If company have large proportion costs associated with variable costs, then operating leverage is high and the beta is low. And the last determinant is the financial leverage. And the financial leverage is the mix of its debt financing versus equity financing. If company borrows a lot of money for its capital, then the company will have high financial leverage, and the company that has high financial leverage tend to have higher risk. So we have three major determinants of beta. And regarding the last one, the degree of financial leverage, we have two specific terms for beta measurement. One is beta levered, the other one is unlevered. And the beta L here means levered, and the beta U means beta unlevered. So what's the difference? Well, beta, the unlevered beta is the beta where we assume that the company has 100% of equity financing. And the levered beta is the beta where company has certain proportion of capital raised by debt. So this levered beta is typically higher than unlevered beta when you consider the effect of financial leverage on its business risk. So the equation here shows that levered beta equals unlevered beta plus times 1 plus debt ratio. D means debt, E means equity. That is amount of capital raised by debt divided by amount of capital raised by equity, then times 1 minus T. Why we need to times 1 minus T? Well, here we consider the tax benefits of debt finance. So when you apply this equation, you can calculate either levered beta or unlevered beta if you know the other one. Illustration 8.3 is very important for you to understand the details of calculating unlevered beta or levered beta given different capital structure. Here capital structure simply means the mix of debt financing and equity financing, which can be captured by the ratio of D divided by E. D is debt, E is equity. So let's have a summary of determinants of beta and relative risk. And this picture showed you three major sources of beta. And on the top, you look at the levered beta. Levered beta incorporates everything. It considers business mix, operating leverage, and financial leverage. Right? On the right hand side of this picture, you see financial leverage. Financial leverage affect this beta. Higher financial leverage means higher beta. Right? On the left hand side of this picture, you see unlevered beta. Unlevered beta has something to do with, first of all, the nature of the business. And the second, the operating leverage. So typically, cyclical company tend to have higher beta than non-cyclical company. Luxury goods company tend to have higher beta than basic goods, higher beta than basic goods companies. And high-priced goods services company tend to have higher betas, and growth company tend to have a higher beta. That is the relationship between beta and its nature of the business. The second determinant of unlevered beta is operating leverage, which is the ratio of fixed costs versus variable costs. The company that has high infrastructure needs or high fixed assets investments tend to have higher beta. Smaller companies tend to have higher beta, and a young company, of course, have higher beta because those two types of companies tend to have low operating leverage, which means they have higher proportion of costs associated with fixed assets investment. Here's a procedure finding so-called fundamental beta or bottom-up beta. First of all, you identify the industry the company operates in. And once again, pro-cyclical companies tend to be riskier than defensive companies. And the second, you found average beta of other company operating in the same industry, and data to equity ratio. They estimate the unlevered beta for the entire industry. And the next step is to get the levered beta for the company, assuming similar operating leverage. And if operating leverage is different, then you needed to do another adjustment to convert this unlevered beta to business beta, which capture the ratio of fixed costs versus the variable costs. So this is the procedure finding bottom beta of a typical company, assuming that you don't have any market data to run regression, but you want to find the beta of a newly listed company. Then the clue here is to find a similar company industry to see what is the industry level beta. Then you consider the difference between this company versus industry average. Of course, this individual company may have different financial leverage. That's one difference. The second difference is operating leverage. Then you incorporate those two differences into your estimation to get individual stock bottom-up beta. The process looks easy, however, it involves a lot of details. So I want you to spend some quality time, going through illustration 8.4 and 8.5 to see how you can get the estimation of bottom-up beta for a typical company. Once again, you consider three key determinants. First one, nature of the business, which can be reflecting business mix. Second, operating leverage, and the last one is the financial leverage. Although market regression is very popular among financial professionals, but bottom beta is equally important and equally popular. And the bottom beta is even more important or more useful than regression beta in the following three cases. The first one is the company that will go through significant changes in operating leverage and financial leverage. And the second is companies that have multiple business sectors or multiple multiple businesses in different industries. And the third one is company uh, that is going through merger acquisition as well as divestiture. So fundamental beta would be very useful for estimating, for getting a really good estimating for the following three types of companies. Illustration 8.7 showed a very good example of how to estimate beta after company going through merger acquisition. And in your exam, first exam, there's at least like a couple questions asking you to calculate the beta for companies that go through acquisition, merger acquisition, divestiture, investment, so on and so forth. Now, the last method is accounting beta. Accounting beta. Accounting beta believes that the market data is not a reliable source for you to estimate riskiness of the beta. Instead, it explores the source of stock price variation. Because it seems that this method believes that operating performance reflecting accounting data is the ultimate determinant of stock performance. If you believe in this story, then accounting beta would be a really good alternative for you to estimating beta. So typically you run regression. Once again, the statistical method they use is to run regression, but you are not regressing stock return against the market return. You regress accounting earnings of the company against the market index. You see, what you wanted to explore is the relative relationship between variation in stock market return versus accounting performance, the variation of accounting performance in that company. So this method once again touches the fundamentals of the company. It can be a really good method, and illustration 8.8 showed you the detail about getting accounting beta estimation. The one very clear drawback of accounting beta is that this method can only be suitable for you to estimate a long-term beta of a company in the past. Why is that? Because of the limitation of data. What's the frequency of earnings that you can get from a typical company? Well, you can only get 4 quarterly numbers in a typical fiscal year or calendar year. Right? If you wanted to run 1 year, if you want to estimate a 1 year beta, they only have 4 observations. And when you run regression, I don't think it's a reliable regression if you only have 4 observations. Even when you do like a 10-year regression, you only get 40 observations, right? And so accounting beta is not good for you to getting estimation of beta for the shorter time period. Any time period shorter than 10 years would generate unreliable regression. So accounting beta looks pretty good method, but realistically you need to look at the number of observation and regression. So it might be suitable for you to get long-term beta estimation, but the problem here is who needs long-term beta, right? And this long-term beta can only reflect what happened during the last 20-30 years, right? And given the significant change in the future, can you learn this beta? But anyway, accounting beta give you a great alternative, right? It may not be the main method, but offer you a great alternative to get this best estimation of beta. So that concludes this video. This video talk about beta. It's all about beta. And we have how many tools do we have here? We have 4 major tools: regression beta, surface beta, bottom-up beta, and accounting beta. Among the 4 important methods, I would say the most important one is the bottom-up beta, which address the main sources of risks of the company, right? Business mix, operating leverage, and financial leverage, right? And when you do regression, of course, you need to recognize, okay, you have many choices regarding the data interval, time period, and a benchmark. And serves beta typically consider so-called mean reversion tendency of beta. What does mean reversion mean? Well, mean reversion means that in the longer term, that the time series tended to converge into its average level. And the average level for beta is 1. If you get a beta is too high, you want to do a little adjustment, showing that okay, in the future beta may converge towards 1. Converge either lower or higher if the current beta estimation is higher than 1 or lower than 1. So that is chapter 8. We just go through half of chapter 8, which is just with beta estimation. Beta estimation is very, very important. For you to get a good estimation of required rate of return, once again, the theory here is CAPM, Kappa S pricing model. Required rate of return equals risk-free rate plus beta times active risk premium. So for your valuation project, I want you to know that before you get into a specific valuation model, what you needed to do is working on those called parameters. Those parameters that is critical for you to get key estimates of required rate of return, the growth rate, cash flow, so on and so forth, right? And for each every parameter, we will address in great details in several chapters. Last week, that is risk-free rate and active risk premium, right? And this week, we will address this beta and growth rate as well as cash flows. So first 2 weeks are extremely important for you guys to get your toolbox ready, right? For each parameter, you need to estimate a lot of parameters before you do this financial modeling to get estimated stock price, right? Those parameters are parameters that are critical for you to estimate required rate of return, growth rate, cash flows, so on and so forth. And right now, this chapter is about beta. Right? And hope you enjoyed this video, and I will see you in next one. Thank you so very much.